So let's understand NAV decay. Is it myth or reality? One of the most common criticisms surrounding high-yield, weekly pay ETFs, particularly those offered by YieldMax and Roundhill, is the concept of NAV decay. Critics often argue that these funds are inherently flawed, claiming that over time, the share price, net asset value, or NAV, will steadily decline as a direct result of their high distribution payouts. While this theory sounds logical on the surface, the real-world data tells a more nuanced and often contradictory story. The NAV decay argument is based on a simple premise, that weekly distributions reduce the fund's price because cash is being paid out, that over time, repeated payouts should erode the underlying value, and 3, that long-term holders are simply getting their own money back. This idea assumes a static system, one where assets do not produce new income, appreciate or adapt, but that assumption is fundamentally flawed. The reality is, weekly pay ETFs are not passive holdings. They are active, income-generating systems, often utilizing option strategies such as covered calls or synthetic income structures. These strategies are designed to continuously generate premium income, capture volatility, and recycle capital into new positions. As a result, the ETF is not simply losing value when it pays a dividend, it is redistributing income that was actively generated. So in practice, this creates a very different outcome than the decay theory predicts. So what does the data actually show? Since inception, many YieldMax and Roundhill ETFs have actually demonstrated a stable NAV performance over time. Periods of appreciation even while paying high weekly income, and no consistent pattern of long-term decay. In fact, a large number of these funds have either maintained their price range or even increased in value alongside continued distributions. This directly challenges the whole idea that NAV decay is an inevitable outcome. Instead, what we observe is a dynamic equilibrium. Income is generated, distributions are paid, value is replenished through strategy execution. Now, does it look like your stock price is going down this week? Let's understand weekly volatility. Another misunderstood component is the weekly price movement cycle tied to dividend payouts. So what happens each week? 1. Pre-dividend period. The price reflects accumulated income and market positioning, then trends upward or stabilizes. 2. Ex-dividend date. Price drops by approximately the dividend amount. This is mechanical, not a loss. And 3. Post-dividend recovery. Market activity resumes as normal. Income strategies continue generating yield. Price rebounds partially or fully in most cases. This creates a repeating cycle every week that can appear volatile, but is actually structural and predictable. It's completely normal. So why does this matter? If an investor misunderstands this cycle, they may interpret normal price behavior as loss or decay. In reality, the drop is temporary and expected. The income has already been delivered. The system continues operating the following week. This is not erosion, it's distribution mechanics. So what about the role of growth ETFs in building balance? While weekly pay ETFs are powerful income generators, a well-designed portfolio should not rely on income alone. This is where growth ETFs come into play. The purpose of growth ETFs is to offset potential long-term price stagnation, to provide capital appreciation, to stabilize overall portfolio value, and to reinforce long-term compounding. Think of it as a two-engine system. So to clarify things, the idea of NAV decay has been widely circulated, but largely misunderstood and overstated. What investors often perceive as decay is actually normal distribution mechanics, short-term volatility, or incomplete analysis of total return, income plus price. When viewed correctly, weekly pay ETFs are not deteriorating assets, they are cash flow systems. So where does that leave us? Rather than asking, will NAV actually decay? A better question is the system generating sustainable income while maintaining long-term balance? Because in a properly structured portfolio, income drives cash flow, growth drives stability, and together they create a self-reinforcing cycle. The bottom line is 1. NAV decay is largely a theoretical concern, not a consistently proven outcome. 2. Many weekly pay ETFs have shown stable or increasing value since inception. 3. Weekly volatility is normal and mechanical, not a sign of weakness. And 4. Pairing income ETFs with growth ETFs creates a durable, scalable system. This is the foundation of the income flywheel strategy, not just earning income, but engineering a portfolio designed to sustain and grow it over time.